Hi, let's build an LBO model today. It's a basic LBO model. It's much simpler than our advanced version, advanced LBO model that we have in a separate video. Now, what is LBO? LBO is nothing but leverage buyout. Usually, private equity firms buy companies using debt. I mean, they fund their acquisition with debt. That means majority of the funding is done by debt, and the remaining they would use their own capital. So these private equity firms do this just because they don't have capital, huge capital, because company sizes are quite big. So to in order to bridge that gap, they use some part of funding as debt. Before building our LBO model, let me walk you through some assumptions here. Let's assume a private equity firm is going to acquire a company called ABC, and company ABC is generating 250 million of EBITDA currently, and we assume that private equity firm is going to acquire company ABC at 10 times EBITDA. This varies between 5 to 15 times. It depends on the type of industry and the quality of the company they want to acquire. And from that, we can calculate enterprise value. That's enterprise value is nothing but your EBITDA into EBITDA multiple. We assume that company ABC has net debt of 500 million. So if you subtract net debt, you get equity value. So this is what the purchase price to acquire company ABC. In addition to this, private equity firm will incur some fees and expenses, other fees and expenses to complete this acquisition. Then we calculate what is the total purchase price private equity firm is going to pay to complete this acquisition. We can link this net debt to our assumption section. We also have equity value here. We also have fees and expenses here. So now we can calculate the sum of all these. So that will give us 2.55 billion. So this is what the total purchase price private equity has to pay to acquire company ABC. We can calculate what is the implied multiple for each item. This is divided by EBITDA. You can anchor this, so you can use this formula for the cells. You can notice that it's that multiple has become 10.2. That's because fees and expenses of zero point 0.2 has been added to your purchase price. Next, we can calculate what's the contribution from each item to total purchase price. So in next we have total sources. How it's going to fund how private equity fund is going to fund this acquisition. This total sources should be same because users and sources should be same. And now we have debt. So we have a separate table, assumption table for bank debt. We are assuming that private equity firm is going to uh, use 6 times EBITDA to fund this acquisition. And next we have cost of debt. This cost of debt usually varies between 3% to 6% for US companies, for US debt, sorry. Now we can calculate, we can link this multiple to our assumption section. From that, we can calculate what's the total debt private equity firm is going to use. It's about 1.5 billion, and the remaining amount is funded by private equity's own capital. That's equity. You can subtract this, you'll get that. So what's the implied multiple? You can calculate. You can use you can use the formula here, right? You could just copy paste it here. Copy that as well. Yeah. And now calculate the contribution of debt and equity, the total purchase price. Okay, so now we have uses and sources of funds. Next, we also have some other assumptions. We assume that company ABC is generating revenue of 1 billion, EBITDA of 250 million, D&A of 50 billion, capex of 75 million, net working capital of 100 million. And we also have other assumptions for 5-year projections. We are projecting for 5 years. We assume that the private equity firm is going to hold this company for 5 years and then sell it. We expect its revenue uh, is going to grow at 7% every year, and margins are going to expand by 1% every year. And we also have tax rate that's 21%. Next, let's build our income statement. So year zero is nothing but our current year, and we are projecting for the next 5 years. Link revenue to revenue assumption here, and we also know that we also assume that it's going to grow at 7% every year. Just anchor this. Then we can calculate what's the revenue for each year. Next, we have EBITDA. We are forecasting all line items in income statement just because to calculate free cash flow, what items we want from income statement and what line items we want for cash flows. We are only focusing on these line items. Next, we have EBITDA. Just link it over there. Calculate EBITDA margin here. That's as percent of revenue. And we know that this is going to grow at 7% every year. No, sorry, 1% every year. You can anchor that. Then calculate EBITDA. Anchor this because we're going to use this formula everywhere. Next, we have EBIT. EBIT is nothing but EBITDA minus depreciation and amortization. So we have D&A in cash flow. You can finish calculating projecting D&A here. Link it to D&A number current year. You can calculate as percent of revenue. Just anchor this. We assume that D&A as percent of sales is going to be same every year. It is not usually it is not same. It changes every year. Usually it comes to as percent of D&A as percent of revenue drops every year. But in our case, we're just assuming the same number for all 5 years. Now calculate the D&A for each year. Just anchor this. Okay. Let's now calculate EBITDA. EBITDA minus your depreciation number. Then calculate EBIT margin. Next we have interest and EBT. EBT is nothing but your EBIT minus interest. The interest will calculate later because that we calculate in the debt schedule. We have it in the down section. So let's complete our income statement first. Your EBIT minus interest gives you earnings before tax. Calculate EBT margin, that's as percent of revenue. Then we have tax rate, we assume 21% for every year. Just link it, anchor this. Calculate tax number, that's EBT into multiplied by tax rate. Then calculate net income. That's EBT minus your tax. Then net margin is nothing but your net income divided by revenue. Okay. Next we have cash flow items. As I mentioned, we are not going to project all line items in cash flow. We are only focusing on few items that we require for free cash to compute free cash flows. Link net working capital to our assumption table section. Now we have as percent of revenue. You can use this entire formula here, right? I think this is perfect. And then calculate change in working capital. Next we have capex. You can use the same formula here. Just link it. I think it's done. No, I think there's something wrong. Linking. Yeah, perfect. The next table we have levered cash flow. That's nothing but your net income plus D&A minus capex and change in net working capital. We can link because we already have these lines. Then D&A. Then capex we are going to take is negative because it's cash outflow, and net working capital is the same because asset minus liabilities, right? It will be negative. Now we have total free cash flow. So company ABC is generating 150 to 200 million every year of free cash flow. Next we have debt schedule. Debt schedule, like I mentioned, we have to compute interest component and what's the current ending balance debt. What debt we use to purchase company ABC, we use that is the ending balance, and you can link it. Our opening balance is going to be last year ending balance. Interest is nothing but your opening balance into rate of interest. And next we have pay down. How much private equity firm is going to pay down debt every year? Usually, private equity firms reduce the debt from free cash flows companies generate. Usually, entire free cash flow is going to be used to for reduce the debt. You can use min formula here because it can take either of opening balance or your free cash flow. We'll make it negative because it's going to reduce your debt. So now your ending balance is opening balance plus your debt repayment. Yeah. So once we have this, you can link your interest amount here. Now we are done with all statements projection. The last one is we assume that private equity firm is going to sell this business after 5 years. So what's the EBITDA number for the fifth year? We have it here, right? Yeah, just link it. And we assume that this business is going to be sold at same multiple they purchased at initially. That's 10 times. Usually it will not be same. it's most of the cases it will be higher than the purchase price multiple. But let's assume the same number for now and calculate enterprise value multiple multiplied by EBITDA, and we have net debt, the ending balance at the end of 5 years. That will give us enterprise value minus debt is equity value. This is the purchase price, sorry, selling price for this private equity firm. They're going to sell this company ABC at 3.4 billion at the end of 5 years. What was the purchase price? You can link it 1.1 billion, right? Yeah. So MOIC. This is multiple on invested capital. This is the ratio of selling price divided by your purchase price. That means 3.2. Private equity is going to sell this business at 3 times more than what they purchased at. And calculate IRR. Which is, yeah, 26%. So this LBO generates 26% of IRR for private equity, and it's actually a good return. Usually, this IRR varies between 15% and 25%. If it is above anything above 20% is always good for private equity firms. That's about our LBO model. Thank you.